Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host here for about the next, we're going to go 20 minutes. I can't decide if I want to get wild and crazy and go back to the wheel in the SPX again. We've had some good success about the last 3 or 4 weeks, just getting a little bit bearish in the SPX. Actually, neutral to bearish is what I would call it. Our mention of iron condors actually wouldn't have been bad trades overall, but we've been only taking advantage of one side of the marketplace. Market has been fairly volatile, but not going anywhere, if that makes sense. In other words, we're up 1% today, and then we're down 1% tomorrow, and we're right back to where we started. And that's kind of been the theme for about the last 4 weeks. But in general, the markets after the end of the week have been down. And so heading into this Friday, we decided to do another skip strike butterfly in the S&P 500 index, the good old SPX. So we did one that expired on Wednesday on the last Options Guy TV show, and the market went down and it expired in we're looking to get 40 cents on that trade. We actually saw it at 45. Somebody that was watching the show, Fresh Prince, came out and said that he executed it for 35. We went back and did one that was trading for 50 cents on Wednesday, if you go back and review the show. And I was able to execute it for 45 cents. And that market is looking strong. The market never really was in danger of reaching our short strike, which in this day and right now would be a good thing, but now we're definitely not in danger. Market is down 1.6%. Looking at right now a little support level around the 5,600. And I do expect those big round numbers. You usually get a little bit of a bounce. It's not that easy to break through those numbers to the downside. And that makes me hesitant because I do want to do a different butterfly. I want to do an open wing butterfly going into Monday, probably using the Wednesday expiration. But right here, I think there's just going to be a little bit of support in the marketplace. I would rather set this up a little bit closer to the close, but I think we're going to do it today. I think we'll just set up our ordinary open wing butterfly using puts to the downside. So a lot of words in there. Let me go in and show the Tradier Pro software. We'll pull that up. And I have the trade already set up for the S&P 500 index. The trade that we did when we put this on the marketplace was at 57.58. And I executed it about a half hour after the show. Our screenshot shows that the midpoint price was 50 cents. I was able to execute it for 45 cents, but I don't know exactly where the market was at when that was executed. And that's for a 1x2x1 skip strike butterfly. It's only 5 points wide, but remember, I'm billing this as an alternative to a short spread, not an alternative to a butterfly, because we just want to try to capture the gain. We're about one standard deviation out. If we did the actual short spread where we just sold the 58.40s and bought the 58.45s, we're talking about a net credit of about 70 cents to the account. We did the skip strike butterfly, which kind of embeds a hedge. And that's kind of a good way to look at it, is we're embedding a hedge into our short spread. We're not going to have to put the hedge on later. And that was a net credit of 50 cents is what we were showing on the show. I got it filled for 45 cents. So you give up 20 cents worth of credit, and then you have the benefit of having a hedge in your account. Now, if the market snaps back or instantly runs up against your long strike, your 58.30 strike here on this butterfly, it's still going to hurt, still going to be painful, but it's going to be less painful because you do have this long spread that's in the middle of it. Now, this entire trade is trading for zero. I can show it. I'll show it in the what if calculator real quick. Let's zoom. I guess we'll zoom from here to there. Actually, let's zoom one more time. Market's all the way down here, so I'm gonna just zoom over here just to show you. So the market's all the way down there. So I was trying to get it in the graph, but it's so far away right now. A couple hundred points below where our long strike was on our initial strike in our call skip strike butterfly. Now it's saying that it's doing it for zero because the price is zero. So this is as of today, but this is the trade. This is the trade that we put on. If the market were to come back 200 points today, which yeah, that'd be great. Wouldn't mind that at all. And land somewhere in here from this point forward, we would like that. We would like the market to snap back. Now, we don't want it to snap on Wednesday. We don't want the market to run up to our long strike. But so this is a very weird trade in that time to K is your friend on the last day of the trade. And you really want time to K to happen. You want time to K to happen because our goal was to try to make the 50 cents when we first initiated the trade. That was our main goal. And if the market did come back and land right here, right at our short strike, which I'm highlighting on the graph, then we could actually put it on for a net credit and take it off for a net credit, which is just a really odd dynamic of the skip strike butterflies. Okay. So let's go take a quick peek at the chart. SPX. So 5,600. How much noise do we have in this area? We dropped precipitously, made a decent mark back. Right about here. So yeah, there's really not a lot of fireworks. So if let's say we go down to the bottom of this channel, if we break down on the open on Monday, we got about 100 points before we hit the bottom of this candle. It's a little bit of, yeah, there's nothing really exciting about the chart right here. Let's put it on. Let's do it. And we can make an adjustment on Monday. I don't mind putting the trade on. I do think it's going to struggle to break through this right here at the 5,600 level by the end of the day. But I'll put it on right now, and I'd probably put this on a little closer to the close if we were taping Options Guide TV closer to the close. But I'm going to do it right now. Let's set it up. We always want to have a trade that we can look at if we can. I don't want to. I know a lot of people will do the trades that we put on. They're not necessarily meant to be recommendations, and that's pretty straightforward. Don't really know what's going on in your portfolio that's out there, but I always like to look at the setup because the setup doesn't change, especially when we're looking at these butterflies. The last two skip strike butterflies, we went about one standard deviation out of the money, bought the 16 delta, went a little bit higher, sold a couple, and then skipped a strike and then bought one. And that doesn't matter if we did it on a Wednesday, did it on a Monday with a Wednesday expiration or on a Wednesday with a Friday expiration. We're always kind of setting them up the same way. So there's something to be learned by putting this all together. And here we're going to do this. We'll do it, and we'll do a Wednesday trade. A lot of times if I'm doing the open wing butterfly that we're going to look at, where we're going to get bearish to the downside, give ourselves a little bit more upside on the trade. If we look at that trade, we will use a Wednesday expiration. And part of the reason, though, that we usually do a Friday expiration is in case we got to make an adjustment. We're going to do this one and do a Wednesday expiration. Once again, it has a lot to do with the fact that the VIX is where it is. We mentioned on Wednesday's show that we might do a VIX trade today, but now we're back up to the 20 level. Wanted to get long the VIX because the VIX was trading down around 18. Now the VIX right now is at 2078. And it's already started to make the move. So I'm going to go back to the SPX. We're going to look at the Wednesday expiration. So Wednesday, so we're getting into April. Yeah, actually, that's kind of the big day, right? Yeah, Wednesday is April 2nd. I didn't actually put that together. And that means that Tuesday is April Fool's Day. So be aware of that. Just thought I'd give you a little heads up for that. So the big news about tariffs and everything, well, I think a lot of it has already played out, but April 2nd is supposed to be a big day as far as news headlines are concerned. Don't want to get long the VIX, but Yeah, I don't mind this. Let's do the trade. What that will expire on the close on Wednesday. I keep going back and forth, and I apologize for my wishy-washiness on the trade. I'm not that excited about it. I'm probably not going to put this one on. But I like to have a trade on to talk about anyways. 5,600. We're at 50. Oh, we already bounced off of the 5,600 level, didn't we? Look at that. It's already kind of came back a little bit. All right, we'll do the 5,605. We're going to go 15 points down. So 6 down to the 590. We're going to sell 2 of these. Oops. Keep forgetting to clear out that trade before I start. Here we go. This will be the official paper trade. Well, an official paper trade for Options Guide TV today. And that's 15 points. And now we're going to go 10. So we stopped short on the short spread. Yeah, that's solid. Wednesday, April 2nd, I'm going to say 240. We're not going all the way to the end of the week. I think 240 is more than fair. Look at that market move. Look at the midpoint just jumping all over the place. I might even toss it in. If I'm going to work it, I'd maybe toss it in at 230 and let it sit for a couple of minutes and then come back and give up that extra nickel and pay the 240 for it. That's oh, wow. That made a big jump down. Yeah, that's the way that I would approach this. Okay, so 15 points wide to start from 56.05 down to 55.90. From 55.90 down to 55.80 is the short spread. So we have a long put spread combined with a short put spread, which makes a butterfly. This means that if it goes below our furthest out strike, the 55.80 strike, that we are still profitable on the trade. And I like to call this an open wing butterfly, not a broken wing. I'm saying open wing because we're opening up a wing. And just like how I like to use skip strike butterfly just in general because we're skipping a strike, I like to call this open wing because we're opening a strike. We're stopping short on the credit spread. What does this do? It makes the butterfly a little bit more expensive. And I do mean a little bit. We're talking maybe 15 cents more, a maximum 20 cents. But you don't have to be so accurate on your butterfly then. So the market is trading right here at 56.10. Like I said, it did kind of go down and bounce off the 5,600 and came back. It's going to struggle to break through that level today, I think. I think today, who knows on Monday. There's going to be, once again, just as the market has been for the past 4 weeks, Mondays have been interesting, right? Just because a lot of news can happen over the weekend. All right. 56.10 is where the market's at. If we go down to our middle strike, which is 55.90, we're doing okay. That's great. But if we blow through that and continue on down, that's fine. So if you do this trade in the S&P 500 index right through April Fool's Day, come back on Wednesday the 2nd, and the market's down here, you don't want to close it, right? Because your cash settled. So if you fall asleep, cash just goes into your account as opposed to the underlying, which is a beautiful benefit of the S&P 500 index. Also, if it comes back and it lands here, all I need to know is if the market is way down on Wednesday morning in our SPX open wing butterfly trade, I just need to know if it gets back to here, right? I don't want it to go beyond to where I could turn this trade into a loser. But I'd like to know if this market gets back to this middle strike right here. And that's where I want my alert at. Because anywhere down here, I know that if I get this done for 240, that this is going to trade for $5, which equates to a 260 win. Basically, a doubler. You put it on for 240, and you made it 240. On the way up, most we can lose is 240. If it lands right in the middle here, the most that we can make if on our 1x2x1 butterfly is about 1,200, and we'll call it $48, $1,248 on our 1x2x1 butterfly. If it went right out at the midpoint, right at our center strike of this open wing butterfly. All right, if you have any questions on this, then I'm going to leave it there. We've done this trade enough on Options Guy TV that if you've watched the show, you would know that this is a kind of a favorite if you're leaning bullish on the marketplace. A little sad that we didn't put our bullish trade in the VIX on Wednesday, but we went with the skip strike butterfly, which worked out. And I was going to land, and I even mentioned on the show that I was going to put that one on inside my account. This one I may put on, but I would put it on closer to the close. You have minimal risk. We do have an adjustment that we can make to it. We can roll it into a bullish short put spread by simply closing this option contract, selling the most expensive one out of the bunch, and then buying either this one or buying another one of these. And that's the adjustment that we make. And that would happen on Monday or Tuesday. On Wednesday, it's a little hard to adjust the trade, just last day. But if the market opens up 1% on Monday morning, or it closes as much as up 1% to 1.5%, which wasn't normal, until until the inauguration. But that has been the norm since then. And like I said, the market's going nowhere, but it's been very volatile doing it. And that's where we're at. All right. So a fun little thing. Thought I would throw this out there. And if you have any questions or comments, please do put them in the chat box. We want to make this as interactive. We do it live for a reason. It makes it a pain in the butt because the markets move so fast that it's hard to get your hands on where your trades actually could be executed at. But with that said, share it with friends, family. Hub.tradier.com. If you want to set up a profile, you'll have access to all the great speakers that Tradier has put together inside their hub. On top of it, you can watch it on YouTube. You can watch it on x.com. So we stream it live almost everywhere. So share with your friends and family. We obviously appreciate that. With that said, we picked a stock that is going up in a down market. And we're going to do that heading into earnings. Kind of a sector trade as much as anything else, but let's throw it in the chart because the chart kind of looks good here. Look at these 3 candles that we've had since we basically put on that trade, and we put a long call position, which is, you might say, is a little bit crazy in this type of marketplace. I want to talk a little bit about that craziness. NEE, which is next era energy, and that's N and 2 E's, and like knee, and that was trading on the day that we put this all together at 69.01. So where were we? 69. We were right here. We're at the bottom of this, and now we're trading at 71.08, and we're up another 78 cents on a down market. So just good signs. Broke above the 50-day moving average. No, this is the 200-day, right? No, the 50-day. That's blue. Red is 20. Okay. 200-day is up here. Okay, so we're still not quite back up to the 200-day. As a matter of fact, that might be a resistance area. We see, I think I've seen it touch. I'd have to add some more days, but that's touched that area a few times. So in this instance, I like where we're at. I like where we're at. You could close it out. The trade is up. I have it in the what if calculator, but I usually want to look for at least a doubler on the trade. I'll put this trade all together. Let's send it into the trade ticket and just see where it's at. We put it on for 380, and we'll be up a little bit on it. One second here. Here we go. All right, come on. There we go. Couldn't get the box to check for some reason. And now it's $5. So 380, a little more than I thought, actually. It's $1.20 that we're up on that trade. So that's not bad. I would have a limit order in to close it out at $7, basically a doubler in this trade. And that's where I'd have a good till canceled order in to sell it for $7. Now, here's what's going on with NEE and what we set up and we talked about on Wednesday's show. If you put in NEE, You see that there are earnings on April 25th, or April with that week. The earnings are April 22nd. So April 25th is the Friday. You're getting that pump up in implied volatility, and this is actually this is probably why it's up more than I thought. Right? I said in my head we'd be up. I said 50, 60 cents, and we're up almost $1.20, almost double that. And that's because we're getting a pump up in implied volatility. So the market is going up and the implied volatility is going up. We paid up a little bit more for the option contract to start with because we bought the expiration that expires after the earnings event. So it was trading at a little bit higher volatility than the April 17th expiration. So we would have saved a few pennies to start with. But the anticipation is that implied vol will start going up. And it's up almost 1%, which is nothing to sneeze at, which is a solid move in implied volatility because the market went up. So implied volatility is starting to creep up, which has rewarded us on this trade. So we got the market to move in the right direction, and we got implied volatility to move in the right direction. Because if I look at this trade and you don't listen to Options Guide TV, I would say, well, why wouldn't Brian just do a spread? The marketplace is tough. There's a lot of premium that's out there. And the answer is because I don't mind owning an option contract that's 30 days out and has an earnings report that's coming. Now, if I wanted to ride it through earnings, which I'm hoping to be out of the trade before, and I don't want the risk of the earnings report. But if I did, I would then leg into a long call spread, right? So let's say you're a week out and you've decided, I think I'm going to ride this through earnings. You would go up and out of the money and then sell some of that juiced up option contracts because of that earnings date. So you can ride the wave if you get the direction right. On this side, you take out one of the hardest things to do in option trading, which is to try to get volatility right. You're 95% sure that implied volatility is going to go up, right? If you do this around earnings. I can't say 100%, mainly because there's always this one off case that it doesn't happen. But with that said, you got volatility on your side. Now you just got to get the direction right. And that's that simple. All right. Any other questions that we have? Any other comments? We did end up doing the bearish, the bearish open wing butterfly in the SPX. Feel fairly good about it. 50, yeah. Especially if we can break through and close below 5,600 today. I would feel real good about this trade if we did. And I'll probably look at it in my account. And let's say we close at 59.95. Round numbers are hard to break through. So if we do that, I might put that on a little bit closer to the close today. No comments. It's kind of surprising. All right. Well, two skip strike butterflies that panned out. We've been bearish now for quite some time. And our AMD trade is still doing well. We did okay in our AMD trade, but we're not. We pulled back a little bit on it. We've been long that one for quite some time, and that was all based off of the chart. But the market has given back. We talked about the adjustment. The adjustment looks genius now. Obviously, hindsight is 2020, where we took some money off the table and we were going to go long the spread. So in this instance, we're at 103. I think there's a real strong resistance around, I think it was around 97, 96. And if it came back to that, I wouldn't mind doing it again. But eventually that resistance, it doesn't resist anymore. And that's kind of an issue. AMD, why do I keep typing C? Yeah, right down here. That's 95 where it's at. And that's where we put this trade on. I think we were at 97 when we put it on, but the resistance really is at 95. Market was around 97. Once again, whenever we're doing the show, all the trades live, so it's where the market is when the show is on, not necessarily when you ideally want to get into the trade. But that's right where we're at. And let's go out here. Let's put in 1,800 days. And I'll show where that starts at. Yeah, right here. So see these levels right there are pretty strong resistance to the downside, and we had it and we popped again, bounced up above the 50-day moving average, but it didn't hold. And now we're back to the 103 level. If it did come back down and held, I would definitely want to get long again and do another trade in it. But that's it for today's Options Guy TV. Thanks for stopping in. We'll see you on Monday. We'll see how our trade plays out in the SPX, the open wing butterfly. And we may make an adjustment if we do get a 1 to 1.5% move to the upside Monday afternoon. Thanks. Please share with your friends and families, and we'll see you Monday, 11 a.m. Eastern Time for the next edition of Options Guy TV. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.